Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today we're talking about the latest interest rate increase announced by U.S. Federal Reserve Chairman Powell. He announced a quarter-point increase in the benchmark rate today. This is despite the fact that the economic data could have easily supported no rate increase. The forward-looking guidance is about as murky as ever. They're pointing towards 2 rate increases in 2019 versus the previous forecast of 3 increases that they set back in September. It's widely assumed that this rate increase means that all interest rates are going up, but that's not necessarily the case. As real estate investors, the cost of capital is perhaps our largest single expense. Some loans are indexed to the Fed short-term rate, others are indexed to the 6-month LIBOR rate, and more importantly, long-term loans are indexed to the 10-year U.S. Treasury bill. The rate for the 10-year Treasury bill has actually been falling since September of this year. While all eyes are on Washington, it's important to note that not every government has raised interest rates. For example, the Bank of Canada held its benchmark rate steady at its December meeting earlier this month, and Canada's short-term interest rate remains unchanged at 1.75%. This, despite the fact that the Canadian economy created far more jobs in November than anticipated. 95,000 jobs were created in November against a forecast of 10,000 jobs. And Canada's unemployment rate is close to a 40-year low. The UK kept its benchmark rate fixed at 0.75% at the November meeting, and it's widely anticipated that due to the Brexit uncertainty, Bank of England Governor Mark Carney will hold the rate unchanged at 0.75% in today's announcement. Mark Carney used to be the governor of the Bank of Canada. He received tremendous amount of international recognition for his expert handling of the 2008 financial crisis in maintaining stability in the Canadian banking system throughout that turbulent period. Governor Carney came under fire recently, though, for predicting dire consequences for the UK economy if the UK exits the European Union without an exit agreement. I actually agree with Governor Carney. I think the UK is headed for a big financial meltdown with this whole Brexit fiasco. So right now, we do not see either British or Canadian interest rate increases in the short term. Germany has also kept interest rates low, and the European Central Bank said that there's no room, or very little room, for raising interest rates in the Eurozone. This widening policy gap is in stark contrast to the Fed, which raised interest rates 4 times this year. The argument for raising interest rates is twofold. Number one, many are saying that they need to raise rates to hold inflation in check. Just as there's been inflationary concerns, we've also seen deflationary moves in the economy. Oil prices have fallen nearly 40% since September. The second reason, I believe this is the real reason, is that if rates remain low now, then central bankers will have no tools left in their arsenal to stimulate the economy if and when we do experience a true economic downturn. And Chairman Powell today said that this latest increase puts us at the low end of normalized rates. So again, that guidance is a little bit murky. I don't know if that means that they're in range or if they still have more room to go. But right now they're saying maybe expect 2 more rate increases in 2019. One of the impacts of higher rates is that global capital will flow into U.S. Treasuries, affecting exchange rates with the U.S. dollar. And a higher U.S. dollar makes countries that export to the U.S. more competitive and makes U.S. manufacturers globally less competitive. That negatively impacts the balance of trade. We could see further reductions in the price of oil, possibly other commodities, as the U.S. dollar strengthens. In fact, as the U.S. dollar strengthened last quarter, the current account deficit widened to a 10-year high as exports fell and imports rose. The current account deficit last quarter was close to $125 billion. So let's get back to real estate. The consensus is we'll expect to see a couple more rate hikes, but we're not going to see anything dramatic in 2019. Some analysts are even saying that we could see interest rates remain flat in 2019. Now, some types of loans will become more expensive as short-term interest rates rise. This is the classic yield curve inversion that economists want to avoid. Going long on debt that's tied to the 10-year Treasury bill is the winning strategy in today's environment, in my opinion. As you're evaluating the spectrum of different loan options in the market, pay close attention to what the loan rate is indexed to. You could experience falling interest rates even in a rising interest rate environment. Have an awesome day. Go make some great things happen. We'll talk to you again tomorrow.